Hello traders, Gary Wagner here just before 11:30 on Wednesday, the 26th day of November 2014, and this is the daily report for gold and silver, our weekend review. Yes, weekend review on Wednesday, as tomorrow is a national holiday and only a half a day trading on Friday. We will not do our regular report on Friday, barring any real dramatic moves in the market. In that case, of course, we would put out some sort of a special report. To the markets today, quietly trading off, quietly trading down a little bit. Gold off about $3 to $4 on the day. 1198 and change is our current print. Now, the high that this market has had is that elusive $1,200 mark, 1200.60, low 1194.60, a tremendous $5-6 range on the day. Silver, as can be seen here on a weekly chart, Japanese average format, also trading lower today, off about 10 cents on the day, 1652, 1653 in that area. We do have platinum unchanged, palladium higher on the day, more on silver in a little bit. Well, as we go into our long protracted Thanksgiving weekend, we are seeing the markets trade pretty much on par in terms of what we have been anticipating, and that was really quiet action as we go into the Thanksgiving weekend, barring any kind of dramatic fundamental shift or change out there, which we really haven't had. We're looking at a very short-term chart, 230 minutes, Japanese average format, and here's what really sticks out. When we look at some of the fib levels that we've identified, and this, of course, is on a very short-term basis, but we're trying to get a handle on really where our real support and resistance are first. And secondly, we have, since the 7th of November, had a series of higher lows. We have also had a series of higher highs, which tells us that we have, on a short-term basis, absolutely without a question of a doubt, an uptrending market. We came off of these lows, this was after we broke our double bottom and now tested a new low, 1130, 1131, that being the mark. However, as we got close and into our holiday season, as you can see, market comes up, it tests this area, and we do not get a higher high. So in other words, what we're getting is some consolidation in the market. Doesn't really tell us whether or not it's going to spurt above this 1207. That's what I am currently pegging as our resistance area. In terms of support, we have a couple of areas, but I would look at our minor support level right now, as we've talked about all week, roughly at 1180. And that's really been my reason for being absent in terms of having an active trade on. I just don't think we have the range, and I believe that in our market forecast yesterday, we put out the following suggestion. Short-term traders can look to sell over 1200, 1207 being the area that you would look to get. The high, of course, what you've gotten so far is up to about 12. And I would buy 1178, 1179, simply because this has been that what we call the sweet spot, or the area in which market's been trading. Now, no doubt we have some real resistance here. I also talked about this level as being support, but we do have another area right now, a minor area, but it looks as though we might be seeing some support come into this area, and that is this 23% retracement level, 1189.24, call it 1190 just to round it off. The one thing that you can see when we look at this, though, let's go ahead and change our color on our highlighter, but that we're starting, it looks as though, or it appears as though, we had some support in this area, because over the last couple of trading days, we have not broken below 1190. We have not broken above, call it 1200, 1202. Now, at the same time, we have seen the dollar succumb to a little bit of pressure, looking at a daily chart in which we can see some real resistance, call it 88.50. That's this high right here that came in 4 days ago now. Last 3 days in the dollar, though, if you look, you've got these very short-bodied, or small-bodied candles, I should say, moving to really the bottom of this channel, which is around 87.50. So 87.50, we've seen some real support in the market. You can see that right here. Again, this is a daily chart, so we do have support in this area. We also have some real resistance right in this area. So we'll see what happens come next week. Of course, we go into our major holiday season, that being between Thanksgiving and Christmas, and then, of course, Christmas kind of leads us right into New Year's. So we'll see what happens in the dollar. But in terms of the dollar, still pretty strong, hasn't really come down hard, and the equities markets continue to rise. And we can certainly see this by looking at the E-mini S&P, this of course being a daily chart, standard candlestick format. We'll go ahead, let's compress this, because what we have really in this particular chart is simply an idea, or the channel lines, the primary path that this market has really taken as it moves up, staying within the lines almost like Bollinger Bands, defining tops and defining bottoms. Of course, this breaking through real hard. This is that one real strong correction that we got beginning of October, taking us about to the middle, and then we had this dramatic recovery, but we're still quite a ways away from the top of this upwardly cascading channel line. So we're at 2073. I believe that that's a new high on the day. We had the S&Ps close higher. We had the Dow close either a little bit lower or just unchanged to a little bit higher on the day. But no doubt you can see this dramatic move, considering it's moved from just above, 1,800 on the S&P to well over 2,000, 2,073, our current closing price just before Thanksgiving. Which really brings us to our longer term view in the market. We'll do that by looking at a Japanese average chart, and this of course is a weekly chart, each candlestick representing 1 week in trading. We have gone green on our weekly charts in terms of Japanese average, and the color coding on this particular chart is very, very effective in kind of taking an overall look of the trend. It's the solid red candles, of course, defining a downtrend, this defining an uptrend, and we getting these significant moves. Now, the question is do we in fact have the beginnings of that type of a move in the market? Because, for example, here you get a beautiful pivot point, market moves higher. Same with this area right in here, you get the market moving higher. However, there are other occasions, and let me point one out, actually most recently right in here, in which, call it a fake out or whatever, but you get this pivotal turn, 2 weeks of slightly moving higher, coming into real resistance this time here about 1262, and then trading lower here to a new dramatic low at about 1130 to 1133. Now, again, we've got these 2 weeks where the market's moved up. And so the real question is, are we looking at the beginning of a scenario where we've gotten this classic V here, pivotal candle, beautiful doji, and then it moves up? Or are we looking at a period in which you've got, due to short covering and consolidation in the market, kind of a false slip? And we can see that here. As this market's coming down right in here, you get, if you notice this area here, you got a couple of weeks up. This area here, you got a couple of weeks up. So it was truly not a pivotal reversal, but yet when we look at it just at the beginning of it, without knowing what happens in the future, of course, it looks as though, or appears as though, you could be looking at some sort of a pivotal move. Here also, you get this kind of a fake out. So my question now is whether or not this is what we're calling that fake out, or a defined bullish trend that kind of fizzles out real quick, or are we on the beginning of a pivotal or a major reversal, and we've seen the bottom. Now, in terms of models which would match those basic calls, we absolutely have them. One model in terms of a bullish model is as follows. And to really view that model, I've got a 2-week chart up, and on this 2-week chart, I'm looking at our major count, our major Elliott wave count, meaning this is our major first, this is a major second right here, the long third wave, this takes us up to our record high, and now we're in a major fourth, this being that down channel, and here's the case that some can make for a bullish model. When we consider this move from $300, or the beginning of M1, to M3, the top of that major third wave, and then we look at the correction that ensued, in other words, from 1900 plus down to 1130, you can make a case for the fact that the retracement we've seen is 61%. 61% is absolutely in alignment because you got a 38% retracement here from this move up. And so a 61% retracement would be on par with the standard model, Elliott wave model, in which when you have these corrective waves, typically one will be much deeper. Typically that's wave 2. In this case, you've got this long, deep, protracted wave 4. And when I say deep and protracted, considering that this is the beginning of 2011, beginning of 2012, so right at the end of 2011, which is right here, you had the market begin to sell off. It's now 2014, going to the end of that, 2015. So we've had 3 years really of lower pricing. And the fact that we had this triple bottom and the fact that we are also above a 61% retracement, well, that bodes for the potential for a key reversal or the beginning of a major fifth, which would really, if in fact we ever saw that develop, would by the nature of how Elliott wave is forecast, would take us to new highs. Now, we're certainly not there yet. We don't even have any kind of technical confirmation that this major fourth is over. And there's no doubt we thought that that was possible right in here. Market moves back up, and then we got this channel again. We also talked about the similarities of the fact that we had the compression triangle up here as well as right in here. So that's the bullish model, a case made for the bullish model. However, my sense right now is based on the fundamentals at play. In other words, what has been really applying pressure to the gold market, strong equities vis-a-vis, and then a strong dollar. If that continues, really gold has nowhere to go but down, barring any kind of massive geopolitical hotspots kind of building up. So my sense is that we could still test this market a little bit lower. And the other reason I believe in terms of a bearish model that we could certainly continue to see some sort of move down is by using the Elliott wave rule of forecasting wave 5, and that typically being equal to wave 1. And here's what I mean. So traders, all I've done is put up a self-auto scale line. That's this line here from the beginning to the conclusion of this wave 1 right here. And if wave 1 and wave 5 are about equal in size, let's go to the top, then we could see this market trade as low as just above $1,000, really about 1040. You can see that. That's where the zero line comes in. So based on this Elliott wave model, we are close to, but certainly not at, the conclusion of this 5 out of 5 to make up a major fourth. So those are our basic bullish and bearish models that are there in the market. There's a case for each, but I think significantly the case right now has to weigh heavily to the continuation of more downside pressure. And that, of course, as I said, is based upon the fundamentals at play. And for those who have been with me for quite some time, you know that I consider myself to be a hybrid technician, meaning I look at fundamentals to ascertain overall market direction. We then look at our technical indicators as entry points, exit points, stops, and actual strategies within that market. That being said, I still think we could see lower pricing. However, there's one other thing we want to look at, and that is when we look at how this market has typically traded at the beginning of the year, January, whether we want to call it a January effect or not. Take a look at 2014. You can see that had you bought it right at the beginning of the year, which we did, you would have gotten this nice clip. 2013, well, it wouldn't have worked out that well, obviously, because this market was still genuinely down. 2012, you had a real nice bottom and play right there. So out of the last 3 years, you would have made money here. You would have really, really gotten trashed here in 2012, 2013, of course, major bottom there. And so we have seen periods of time, and I can show you this again. This is beginning of 2011. And then, of course, in these areas, as the market's going up, you could have almost bought anywhere and then still had a nice trade to the upside. But for some reason, I have always historically looked at January as potential bottom in the market, and of 1, 2, 3, 4, the last 5 years, there's only one occasion when that strategy didn't work. So we are going to see where we're at come the beginning of January, and I expect that we should see some weakness up until that point. And then finally, silver. Silver has actually shown us some dramatic support, which entered the market roughly at about $15 per ounce. That's right in here. We've also seen our first real level of resistance based on this 23% retracement level, roughly at 1662, and I think that that is also still in play. Traders, I want to wish all of those that celebrate Thanksgiving as who live in the mainland a happy Thanksgiving. I also wish to let all of our subscribers know, no matter where you are on this planet, that I want to be very, very thankful that you have been a subscriber, and I want to wish you a happy Thanksgiving irregardless. We can all use wishes of good faith, wishes of happiness. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you after the Thanksgiving weekend. Have a great weekend. Bye-bye.